Europe seems to be where the real concern perhaps should be, particularly if it's an overly cold winter. What are you seeing there? What are your expectations? And why the move up today so strongly here in the U.S. as well?
Well, the move today is primarily driven by an updated weather forecast that shows a big cold front moving in. And you're probably asking, how can a weather forecast create this kind of move? The market's finely balanced based upon a normal weather. So if we get a cold winter, you're going to stock out. And if you stock out, you're going to have to do like what they're doing in Europe right now, which is gas to oil substitution. And if you have to use oil in lieu of gas, you got to go up to $10 an MMBTU. So that's a big move from where we are today. And if you end up having to destroy industrial demand, you got to go all the way to 16. That's why the market is so sensitive to these weather forecasts. Is just, all of these markets, whether if it's in Europe, China, U.S., they're struggling because of underinvestment in supply. And, we've had a big recovery in demand. Inventories are exhausted, and any type of little disruption creates a spike in price. We like to say, the persistency of transitory shocks, because the system, normally it take a tail event to create a price spike. Now it just takes a draw from, the center of the distribution to create a problem. So we think this is just going to be a feature of the market.
But back to the U.S., though, natural gas market. I mean, we're awash in natural gas, aren't we? Maybe is the issue just not getting it where it needs to be? I mean, heck, we export about 20% of our natural gas right now. I mean, we're not facing anywhere near the same problems they are in Europe, are we?
Today, we don't have a problem, which is why, if you have gas in the U.S. is trading, call it $5.60. Gas in, Europe is trading $30 plus, as well as in Asia. Now, right now, the U.S. doesn't have a problem, as you're pointing out. But if you go through the winter, you draw your inventories based upon normal weather, you'll be right at the edge of having a problem. So that's why if you have colder than normal weather, you'll end up finishing the winter with a critical inventory level, which will require that big spike to 10 or 16. So right now, all the market is trying to price today is the potential of a stock out because of the forecast for below normal weather.
Which is weird because it's 70 degrees in New York City today.
Yeah.
Jeff, what about oil prices? We're approaching your, I think, $90 per barrel target here pretty quickly, maybe faster than you expected. Are you going to have to revise that higher? What's driving this?
Well, I mean, the market for oil is very tight. It's the tightest today as it was in the 1990s. And we had a big rally last week, but I think the more important development in oil is the extreme level of backwardation that has been generated in the forward curve. Now, what I mean by that, spot prices sit above forwards. What that is telling you is that you're willing to pay a premium to have that commodity today and not tomorrow. It means there's scarcity day. Think about it as a scarcity premium. That scarcity premium is as large today as it was in the 1990s, which is an indication that this market's really tight and inventories are getting critically low. Again, it's kind of like natural gas. We're not at critical operating levels like we are, let's say, gas in Europe or coal and gas in China. In oil, we don't think you hit those minimum operating levels until right after the first of the year. Now, here's an important point to go into your question about what are the upside risks. If we get to a situation where you have to actually ration demand, we estimate that number would be $110 a barrel versus 90. So you can think about the bid ask going into the winter as being 90, 110.